Good morning. Now in this class we are dealing with the remaining advanced accounting standards. Now I am going for accounting standard 24, and that accounting standard 24 is nothing but discontinuing operations. When we come across some businesses, some companies, what they will do is, due to some reasons, whether lack of capital or whether lack of managerial ability or some other reasons, they'll discontinue the operations and they'll discontinue the business. So in that case, the operations, what we have to do, what is the ultimate result and what is the ultimate procedure that we have to do, that we have to undertake. This thing, it was detailed in this accounting standard 24. Now coming to accounting standard 25, interim financial statements. Interim means in middle. In middle, suppose if you take into account a financial year, that is, this financial year takes into 12 months duration. Suppose if the management people or if the owners, if they want to know the financial position as well as the financial statements in between accounting period, then we have to take into account this interim financial statements. And this interim financial statements, it may be after half an year, after 8 months, or at any time they will go for this interim financial statements, and accounting standard 25 deals with this interim financial statements. Now after that, accounting standard 26, intangible assets. Intangible, that it means that they are not visible to naked eye. Tangible assets like buildings, machinery, furniture, cash, bank, etc., they are visible to the naked eye. Intangible assets are those things that we cannot able to see with our naked eye, but they will help the business units or the company in carrying on their businesses. For example, goodwill, patents, trademarks, all these things we can segregate in intangible assets. And goodwill is the main thing that we come across when we go for an intangible asset. We cannot see goodwill with our naked eye, but we can feel. When we are taking this goodwill, some people, they'll say that, sir, you are telling that we cannot able to see with our naked eye, but why we have to consider that in these businesses? Because even though it is not visible to our naked eye, it will help in the promotion or in the further progress of a business. That's why people, they'll go for goodwill and they'll give importance for goodwill. And this accounting standard, that is accounting standard 25, 26, it will take into account the intangible asset. Next, accounting standard 27, financial reporting of interest in joint ventures. Financial reporting of interest in joint ventures. This is accounting standard 27. So when we go for joint venture businesses are nameless partnerships. When we go for this nameless businesses, that is joint ventures, how we will treat this interest amount? In what way we will show this interest amount in financial statements and in financial reporting of this interest? Sometimes we have to pay interest and sometimes we have to receive interest. And this interest amount, what we are receiving and what we are paying to outsiders, it should be shown in the financial statements. And again, the report must be given to the management people regarding the treatment of interest in financial statements. So that is nothing but accounting standard 27, that is financial reporting of interest in joint ventures. Now coming to accounting standard 28, impairment of assets. Impairment, that is, we can say that we cannot pay impairment means we cannot pair the assets. For example, a small example, land and buildings and plant and machinery, these are the visible and tangible assets. And we cannot pair them. Land and buildings, it is separate, and plant and machinery is also separate. So this is nothing but impairment of assets. When we come across different types of assets like fixed assets or current assets, whatever it may be, we have to pair them, we have to club them, and we have to show them. Of assets, whatever it may be that we come across, we have to deal in this accounting standard. Now coming to pairment. Sir, you are telling about impairment of assets? Fine, good. But what about pairment? Pairment means we can pair them. We can take them into, for example, sundry debtors and bills take into account. Previously, people, they used to call that thing as separately, that is sundry debtors and bills payable. At present, when we take into account the modern accounting standard, modern accounting businesses and modern businesses industries, they'll pair them and they'll take that as trade risk. So there they are taking into consideration both the things, that is sundry debtors as well as bills receivable, and they are calling with a single name as trade receivables. So there you will come across pairment of assets. When we come across different types of assets, sometimes we can pair them and sometimes we cannot pair them. So whenever we cannot pair them, we'll call that thing as impairment of assets, and this accounting standard 28, it deals with impairment of assets. Now coming to 29, provisions, contingent liabilities and contingent assets. Provisions, that is, we will provide. As a matter of fact, they won't come, but we will provide. Like provision for doubtful debts, provision for bad debts. Okay, all these things we are providing in the business, thinking that they may not come. We are making a provision and we are showing them in the accounts. And when we come across provision for account on creditors, provision for doubtful debts, provision for bad debts, provision of depreciation, provision for taxation, all these things we are keeping. The accountant or the company people, they are providing, thinking that they won't come across. And when they won't come, okay, how we have to treat them, how we have to show them, that is the main thing that we come across in these businesses. Next, contingent liabilities and contingent assets. What is this contingent liability? It is not a liability at all, but it seems to be like a liability. Similarly, contingent assets, they are not actual assets, but they appear as an asset. Okay, when we come across these contingent liabilities and contingent assets, how we treat them in preparing our financial statements. Whether we have to consider this contingent liabilities and contingent assets in our books, yes, we have to, and we must take them into account. Because contingent liability, even though it is not liability and seems to be like a liability, we have to consider that and we have to show them separately. In the same way, contingent asset, even though it is not as an asset but seems to be like an asset, we have to show them in the books of accounts. And we have to treat them in a separate manner without including that with the other liabilities or assets. That is the main thing that we have to remember in this. And provisions, contingent liabilities and contingent assets, when we come across, how we have to deal with those things, this accounting standard 29, it deals with that. Now coming to accounting standard 30, financial statements, recognition and measurement. You see, after doing a business is not a big criteria, but thing is, we have to prepare the financial statements. When we prepare the financial statements, people, they must recognize that the financial statements are prepared and they have to measure that. Measuring in the sense, how much expenditure we have come across and how much income we gain, and whether we are coming across any profit amount or loss amount, which one is more, whether the income is more or expenditure is more, people they will look after. So first of all, not only taking into account the financial statements, people they must recognize, they must understand. When they cannot able to understand and when they cannot able to recognize, okay, it is mere waste to prepare the financial statement, that is profit and loss account and balance sheet. So compulsory we have to recognize the financial statements and the measurement. When we take into account the financial statements, different businesses, okay, following different, prepare different financial statements. For example, trading organizations, they will prepare trading and profit and loss account and balance sheet. When you go for a manufacturing concern, they will prepare manufacturing account, trading account, profit and loss account and balance sheet. When we come across service organizations like hospitals, hotels, schools, colleges, they have to prepare receipts and payments account and income and expenditure account and balance sheet. So the people they must understand and they must recognize that this type of financial accounting was prepared by these institutions, by these organizations, like that, and measurement must be there. This is about accounting standard 30. And now we are going for 31. We are going for 31 accounting standards. Okay, presentation. Okay, we are doing business. We will come across so many transactions. All these things, they must be shown properly. They must be presented properly. There should not be any jumbling. There should not be any jumbling in showing the financial statements. They must be shown in a perfect manner with different schedules, different working notes, everything they have to present. Then only people they will understand, and otherwise people they cannot be in a position to understand. This presentation, accounting standard 31 it will take, and after this accounting standard 32. This is also accounting of financial statements, disclosures. This is very, very important from the business point of view. We have to disclose every information. We have to disclose complete information to all the people whom what they require. Even though statements are prepared in a precise manner, the concerned working notes, concerned schedules, they must be disclosed to the parties when and where necessary. So this accounting schedule, it will take into account that disclosures. Because without disclosing the information, without showing the information, one cannot achieve anything. To any person, whether he may be an employee, whether it may be a management person or it may be an outsider, compulsory you have to show that to all the people without any fail. Because financial statements we will prepare in a precise, very, very precise manner. Now people, so many people, they are preparing this vertical manner. When we are preparing the vertical manner, it is nothing but a precise way. But thing is, we have to show the various working notes, various schedules of these financial statements. We have to represent that. Thereby people they can be in a position to understand what is happened, in what way they are showing the results. Because all the things they cannot and they may not position to show that in the financial statements. That's why in a precise manner they will prepare, and the concerned precise information they will give in detail in various working notes. This must be observed by all the people. Thereby they can able to understand what happened, in what way they are showing, in what way we have to take that, what is the result, in what way the result are shown. All these things they will come to know. So with this I am completing the 32 accounting standards. Whatever it may be the doubts and whatever it may be the clarifications, whatever it may be the things, you please keep them in comments box, and please hear and please subscribe to this class. Thank you very much.